Okay, welcome everyone. We'll start lesson 3 to today lesson will go through LO3, which is be able to prepare financial reporting statement for different types of organization. This will be today lesson LO3. So next lesson will go through LO4. Okay, so up to now we have discussed types of ownership. We discussed types of financial statements. We discussed balance sheet, profit and loss, and equity, how we can prepare manufacturing account. We discuss IS 1, 7, and 2. That was, in our discussion. Uh, current knowledge about financial statement. Do we know how many types of statements? I think so. We know all. Yes, 4 types of financial statements we prepare. And do we know non-current asset register? Anyone working non-current asset register? Or of course, maybe you all working on non-current asset register. That will be the key, in our discussion today. Okay, so how we can do the valuation of non-current asset? Non-current asset mean the long-term asset which we can use more than a year, and different depreciation methods, straight line reducing, calculating net book value, valuation of inventory, how we can do, and we have IS2 for inventory valuation. Irrecoverable bad debts, which we can't recover. Provision, we can create the provision, and it can be allowances. Allowances can be overestimate or underestimate, so we can make the adjustment. Accrual and prepayment, that's, and then application of relevant standards. So that's all will be private, public, and various other companies and the statements. Okay, statement we already discussed in the previous lesson. So first, describe the treatment of non-current asset in the financial reporting statements, we call financial statements. Accounting is the way, we record in the log and summarize the transaction. So sole trader partnership limited companies, we know the difference between them. 1%, 2 to 20, and a limited company can be private limited and public limited, and it's a separate legal entity. So we keep the non-current asset register. Okay, do we deal with the non-current asset register? Yes. Are you maintaining? How you decide the depreciation? What do you think? Any method we use depreciation? How we decide, depreciation methods? Is it depreciation is allowable for tax? Anyone? What do you think? Depreciation is not allowable for tax purposes. Only capital allowance we can claim. So depreciation method, of course, it's a market research or your own, or the surveyors can say, this asset need to be replaced. And whatever method you like to use, reducing balance method, straight line methods, some of digit methods some people use as well. I'm not sure you ever used or not. Anybody, any question regarding the depreciation methods? We all okay, depreciation methods?
Sorry.
Okay, good. So next, not-for-profit organization, of course, we can use the non-current asset as well. For charities, we can use the non-current asset register. Regulatory framework, limited companies are required to observe the various rules, which normally they are using IS, International Accounting Standard, IFRS, Financial Reporting Standards, or local standards, whichever country they operate. And plus, the company house, the regulation. Always the financial statement need to be true and fair. So that's why the non-current asset need to be reflect, true and fair value. So we have 3 types of values in major. So we can say net book value. Then we have cost value. We also call carrying value, net book value, or we call carrying value. And then we have a fair value. We use the term market value, and we use the term economics value. Do we know all, the difference between these? Anybody, any question?
I thought fair value and market value were one and the same. Is that not fair market value? But economic value is what you could realistically realize for it.
Yes, so we can say economic value is value in use. Yes. So what economic benefit you will get out of it? So if we have a photocopy and we put it in our book of account, 5,000 pound is the value, but actually it only give us the printing facility up to 3,000 pound. So it should be adjusted our asset value to economics value 3,000. Yes. So because the economics value is a key criteria as well to measure it. And we have a IAS 38, which is called fair value adjustment. So we have to adjust the assets according to either the market value or fair value. So whichever is the lower. So we not give the our estimate to our user that we need to be true and fair, which is match. So net book value is the value after the depreciation accumulated. Carrying value is the same. Cost value is mean the value when you purchase the asset. Fair value and the market value are the same thing. Value in use or economics value normally is the same thing, same term. Huh? So these are the key things we use. If you have a question, you can ask, please. Huh? We all okay for this? Yes.
Mm-hmm.
And the non-current asset register we separately, and the disposal and addition in the non-current asset values we carry on making adjustment, and we carry on transferring in our, if it's the addition and if it's the gain on disposal, so it goes with the profit and loss, and we carry on maintaining. So definition of non-current asset, we already know the asset is purchased when intention to use for long term, and any asset you purchase or spend money to improvement, that we call capital expenditure. Day-to-day asset and capital, all the capital expenditures goes in the balance sheet. It's mean the non-current asset values or asset values. IES 16, which is about property, plant, equipment. So where the enhanced value of the asset, major component of the asset is replaced or restored, or inspection of overall of assets. So that's all come under IES. And the depreciation method also part of IES 16 as well. International Accounting Standard 16. Financial purchase of financing the purchase of the non-current asset. Yes, we can purchase the non-current asset through different. Always look the tax implications as well. So like we can purchase asset through cash, we can purchase asset through loan, through hire purchase, through part exchange. You can give old asset, you can buy the new asset, and finance lease. So each, we have a treatment, and it impact, our liability, our asset, or reduce our asset. Because the cash also asset, or we can replace one asset with other asset. Okay, so that's all. And then the non-current asset, we previously established the capitalized in the statement of financially position. Accrual concept, costs incurred in the period should be matched with the income or produced in the same period. So non-current asset are purchased to help to generate. So what is the definition of asset? Anything you own it, anything which will give the future economics benefit is your asset. If we have a Windows 98 CDs, but no one is using it in our warehouse, and we saying we have an asset, so it's we are not telling the true value. So we should reduce according to the value in use or the fair value, whichever is the lower. So we need to make adjustment. Okay, depreciation. Yes, we can calculate the depreciation straight line, or reducing balance method, or with sum of digit, or the using method as well we can use. Okay, so here depreciation method is discussed. So if is using straight line, if we have a residual value, which is end of the asset, or we call scrap value, cost minus value, divided by the number of years we can, our economics value, which we can use the asset 5-year, 10-year. So, and then you can, straight line mean the same depreciation every year. But when we are using diminishing balance method, so please, you don't need to be minus the residual value, scrap value. So you carry on calculating as a percentage previous year depreciation, you carry on minus, you find the carrying value and always calculate the depreciation and the carrying value. But when you're using the straight line method, you use the cost value when you bought the asset. And the straight line means the same depreciation every year. Okay, so that's, we can use the concept. Any questions?
No.
Okay. Then I included one or two questions here. You can look around to purchase the machinery, 20% per annum on the diminishing. So you can look around the first year, 20% depreciation, then minus if we want second year. Yes, you will see the following year depreciation values will be lower. Okay, because the carrying value will be lower. So that's the way we can calculate here. Unit of production method, yes, how many units we can produce through machine, then we can depreciate. So value is 10,000. We can produce 10,000 units a day, and we already produce 1,000 units. So we can multiply with 10,000 times by 1,000 divided by 10,000. So 1,000 will be depreciated. Yes, if you produce 1,500 units, so there should be a 1,500 value of the machine should be depreciated. So that's the way we can calculate and use. Okay, next we have calculate the record period and adjustment. Okay, there is a called IES International Accounting Standard called post events adjustments. If your financial state not signed and not available within 90 days end of the year, then of course you can make the adjustment. If not been signed off, if been signed off, then of course we don't need to be. We can make adjustment in the accounting period. But there is maybe the significant other materiality issues. Material mean anything which can be influence the financial decision of our user, so we should reflect it in our notes. Even so, irrecoverable, the bad debts which we can't recover it, of course they should be reduced or trade receivable, and the irrecoverable goes in the profit and loss. Allowance, yes, is the estimate. This can be go up and down in the period. We can make adjustment as well. That's called allowances for doubtful debt adjustment. So gross receivable less are irrecoverable for this example. And then if it's allowance, so you can calculate the allowance and you can minus as well. Okay, so that's and debit the allowance and credit. Any question?
No.
Okay, next this is all about after bad debts and adjustment in the profit and loss. Increase and decrease can be in the following year. Few these example adjustment T accounts, please. You can look around as well. I think so you all know, so I'm just a bit skipping. So if it was overestimated and underestimated, so if you underestimated, increase your expense. Overestimated, it's meaning you reduce your expense, so profit will go up and down. So next we've been given the extended trial balance here, which is we have, and then we have adjustment there. So 10,000 is the machinery, 6,000 is accumulated depreciation. So our net book value will be, and this goes in the statement of financial position are after the minus this the net book value. And the allowances for doubtful debt we can make adjustment. Joint is also part of the capital which we can minus and reduce the capital. Irrecoverable can't goes in the profit and loss. So these are all adjustments which we can make it. Okay. Next we have 3.3, which is our assessment criteria. Prepare the financial reporting statement from the trial balance. So given the trial balance, sales goes, you need to look around. In the trial balance given on the credit side, it should go in the credit side, either the statement of profit and loss and balance sheet. So you have to decide which statement. So sales goes in which statement? We all know this. Sales goes in the profit and loss. Purchase goes which statement? Profit and loss on the debit side, because these are also our expense, and income and expense goes in the profit and loss. Then we have an inventory. Inventory goes which statement?
Financial position.
Opening, the written opening inventory. Opening inventory goes in the profit and loss, because this is the, do we know the cost of sales formula? Cost of sales. Cost of sales equal to opening inventory. You write is inventory also goes there, but is a closing inventory only. So opening inventory plus purchases and minus closing inventory, and closing inventory is always goes in the both statements. That's given here in the trial balance. You will see the statement of profit and loss 2200 and statement of financial position. That goes both. It's the debit side in statement of financial position, because it's the asset, and this will closing inventory will reduce the cost, because you purchase the thing which is still left in our stock, we not sold it, so that's still our asset. So opening purchases minus closing equal to the cost of sales. Okay, so this is called and then of course you will see there all other expenses. Sale ledger control account, also known as, anyone knows what other name we can use?
Trade debtors.
Excellent. So debtors we call trade receivable. Why we have? Due to the credit sales. If we are selling things on credit, then of course we have a receivable for future dates. So that's we need to, that's goes in the balance sheet, and the bad debts adjustment we need to make it within it. So right, irrecoverable and all others. Okay, so if not, we make initially. So then we can, like we have example here, you present with the following list of balances, produce the trial balance, extract the profit and loss, and convert this standard comprehensive statement from these, that we need to. So we have been given the amount, debit and credit, and from these, we can prepare the statement. So this is the statement which is already prepared, profit and loss. Yes, so sales, less sale return, my net sales, then my cost of sales, opening inventory plus purchases minus closing, that's my cost of sales. Sales minus cost of sales equal to gross profit. Gross profit mean what cost you and what you sold it. But then we have overhead expense, or we call indirect expense, discount allowed, vehicle expense, wages, and all of this, and then my profit. We have a loss in this case. No, this is the minus, and we can calculate profit or loss for this period. So that's my total expense, and that's the difference will be our profit. Okay, then we can prepare the statement. If we use the IES International Accounting Standard, because IES have the layout, we use the word revenue instead of sales or turnover. Then is the cost of sale, because the cost of sale they do separate working, and they just put cost of sale in the working given underneath. And then left they charge all overhead expense to distribution costs or admin costs. Okay, that's because according to IES, because this is a standardized system, end of the day it's the same thing, but it's a different display unified system throughout the world. Finance costs, also known as the interest on loan, tax for the year, and then of course we'll get the profit. I copied the link here. Next 3.1, analyze the components. So different components, of course, if you look the profit and loss, if you look the balance sheet, we have a non-current asset, current asset, These are all the components. So I copy the link. Please, in your own time, you can review these statements to look around how this affects, and what's happened last 2 years. Statement of financial position of that statement of. So we can copy this link and quickly we can look around one company. You can use different years if you want. So as we have Control F, we can put income statements, group income statement, page 92. And say 92 if it can be pulled up, not correctly reflect the title page as it is. And this is the group statement. Group means they have so many subsidiaries companies. So we will see the continuous operation, which is sometimes discontinuous. One unit of business we can discontinue, and still we can earn the profit. So this is the year. 52 weeks is given the 19. Of course, now is the 20th is available. 2020 statement as well we can download. So this year in the last year, so there is an increase. You look around the cost of sales, then the admin expenses, distribution expenses, all we've been given operating profit through before tax and after tax, and then they have a discontinued operation and then show overall how much they have profit element. They have overseas, parent, and non-controlling. Do we know? I think so. We already discussed parent and subsidiary company. How many percent share you own in other company is called subsidiary? Anyone knows? We all know.
So I can't hear you very well. My Wi-Fi has dropped.
I'm saying, how many percent of the share you own in of other companies called your subsidiary? Do you know the percentage? So parent, let's say you are the Tesco is the parent, and if they have a subsidiary, so how many percent shares we need to own it?
51%.
50% or more, which is basically 49 plus.
Mm-hmm.
So that is called your subsidiary. If you own 20 to 49%, that will call your associate company. And if you own less than 20%, you have investment in other company. This is simple investment. So you have influence on the board of director. You can prepare the consolidated statement, and that's all we can show in our financial statement as a group. So in the Tesco statement, that's why it's given here group. So this is the group statement where included the subsidiary company given. So that's the key. Okay, any question? Okay. So that's we can look around. Then if we further go down, so we can find the balance sheet as well. We can look around the component. This is the group comprehensive income, and then group balance sheet. We can look around the non-current asset, which is we can use the long-term, current asset short-term with the check carry the value, current liability. The net asset figure is always equal to equity figures. So always accounting equation, net asset always equal to equity. Equity mean the share capital or investment in the business. So that's all for these, and you can look around other companies. Okay, then we prepare if we have using the IES 1 International Accounting Standard. And we can show like we have a revenues here, cost of sales, and the working we can show separately, and we can cost reference on working. And then statement of change in equity. You will see there And then other statement of financial position. That's, and you can show adjustment, if we need year-end adjustments all. And I copied the link. It's sometimes it's work absolutely fine, sometimes didn't, so you can copy and paste it. And then of course, the further is a quiz, please. You can go through is income statement quiz. I know I don't know. So always good to be, you can copy the link, please, and click, I'm right and wrong. Okay, if you want to be dig out further, you want to really do the practice about financial statements, I copy for you link there. So please do a bit quiz your end as well, which is ATHE Online and any other awarding body can be. Just 1 second, I can show you and then you can go through your own time. Okay, so accounting AQA, and if you look, we are doing, you can, this is, the financial statement quiz. So I can copy, so you can look around the accounting equation, business A, business. So business A has the asset and the liability. How much will be equity? Anyone knows? What do you think? 50,000 asset, 20,000 liability. What will be equity figure then? Business A.
30,000?
So you can write there
30,000.
20,000 and right, yeah. And same way you can fill it all others, and then you carry on moving to the next question. If you don't know, at the end will show you answer. You can review as well. So conceptual framework, what is about fundamental qualities in the financial statements? Two fundamental. Which two fundamentals are? Anyone knows? The quality need to be in a financial statement.
Going concern?
Going concern is mostly accounting concepts. Yes. That is it relevant? Yes.
Data representation and verifiability.
Yes. So these are two basic, and then we have an enhanced. Comparability is an enhanced characteristic. Further 4 enhanced timeline. Comparability, understandability. So these are the two are the basic qualities need to be in the financial statement. Then you can look around asset goes, which statement if you think, so asset goes in, income goes there, so you can pick, these boxes. Is quite good to do practice, yes, in your own time. So please do so as well if we can, before, so I can look around here. You can say homework. Okay, that's all, today about the financial statements. That's the key, how to prepare non-current assets register, and look around, how we can make adjustments and appeal adjustments. That's all today. Please do so, that will help you because all you working in accounts, the basics. So if you want to somebody so books and everything is available on Moodle. So please, you can do practice if you want to do some. If anything you not get, please drop me emails and I'll try my best to get back to you as soon as possible, and we can discuss. We can arrange one-to-one tutorial if we need to. Okay.
Thanks, Anjan.
Thank you.
Thanks for attending, and hope so I'll speak to you during next week. Have a nice weekend.
Cheers.
Bye.
Bye-bye.